You're watching In Your Interest, and the big story we're talking about here on the show is the big question: will the Reserve Bank of India cut rates at its latest policy meeting, considering how food inflation has gone through the roof? The RBI Monetary Policy Meet has kicked off today. The three-day meeting will end on the 6th of December with Governor Shaktikanta announcing a final decision. The meeting is happening against the backdrop of a slowdown in India's GDP for the second quarter of the year. Remember, India's GDP stood at 5.36% in Q2 of the current financial year. Not just that, India's retail inflation surged to over 6%, 6.21% in the month of October, breaching the Reserve Bank of India's tolerance band of within 6%. This marks a sharp rise from 5.49% in September, driven largely by skyrocketing food prices, which, incidentally, food inflation jumping nearly 11%, 10.87%. As households feel the pinch of soaring costs, the big question looms: will the RBI reconsider its rate cut trajectory amidst mounting inflationary pressures? So we have Mr. Vivek Kumar, economist at QuantEco, joining us on the show. For more on that, Vivek, talk to us. You have the inflation number going up, you have the GDP number coming down. What do you think the RBI can do? Because the problem here is that you damn it if you do, damn it if you don't.
So correct, food has been playing a spoiled sport of late. And in fact, out of, let's say, the headline 6% plus print that we saw last time, almost 9% plus was on account of food inflation. So 9% year on year is food. The non-food part is still pretty much docile. So the problem essentially boils down to having a control on food inflation rather than rest of the basket. So fuel, which is pretty much in negative territory for more than a year now. Core inflation, which is your food minus fuel, is still pretty benign. It's still under 4%. So, if you have to take that overall view, then it's food which is spoiling the party.
Food is certainly spoiling the party for inflation. And in this context, tell us, you there at QuantEco, what is your assessment? What do you think the RBI's policy stance be at the end of this latest Monetary Policy Committee meeting?
So we, as a house, QuantEco does not believe that the MPC is going to change its monetary policy stance, which is likely to be maintained at neutral for the time being. And the reason why we say is because, as you said yourself, the headline inflation is pretty high. Within headline, one particular component is too high. And looking at what their mandate is, which is to have inflation as close as possible to the target, which is 4%, it doesn't give them a lot of room. So from a mandate perspective, they don't have much leeway. So we would expect these stance to be maintained at neutral. Having said so, there are also concerns which have emerged in the very recent past. So both globally as well as domestically. Domestically, we saw the Q2 GDP print undershooting expectations by a significant margin. At the same time, globally, things have become much more uncertain. The geopolitics has been on a slippery turf right since 2022, the Russia-Ukraine war, and then you have these disturbances in the Middle East. So it's been a simmering situation as far as geopolitics is concerned. Now, with the change of regime in the US, the geoeconomics is also going to be highly unpredictable. We saw some bit of overtures being made during the election campaign, and in fact, even before Trump has assumed power, which is going to happen in January 25, the initial sound bites which are coming from the US gives you an indication that the entire geoeconomic world order might be in for a reset. So it's an unpredictable time from a trade policy perspective. It's unpredictable time from an immigration perspective. It's unpredictable time from a tax perspective. So a lot of uncertainties as we go into 25. So RBI probably would also take that into account and its negative spillovers on growth. and possibly try to give a feeler to market participants in terms of how they could look at maybe accommodating in a bit by bit manner. And one way to do that would be to start uh, neutralizing the effect of FX intervention, which is currently happening. So currently, RBI is selling dollars in the foreign exchange market. That dollar selling is sucking out rupee liquidity from the money markets. So essentially, what the RBI could at least start doing on the margin is start infusing primary liquidity or start sterilizing the impact of its FX intervention, so that the money market rates do not harden incrementally. So if it hardens incrementally on account of FX intervention, then it would run in contradiction to the neutral policy stand. So we would expect some sort of a liquidity support from the central bank, and to us, CRR cut seems to be a logical choice to do that.
Right, it is a very sticky situation for the Reserve Bank of India, isn't it? Global central banks across the board are cutting rates, but in India, growth is slowing, inflation is rising. It's going to be very difficult for the Reserve Bank of India to make that tightrope walk.
Yes, I absolutely do agree that it's a tricky situation to be in. And a quarter ago, we probably would not have imagined this situation would be playing out, because food prices in India, they are notorious for being volatile. And the current situation, you can blame it entirely on food. And within food, it's not the entire food basket which is misbehaving. It's select food items which are misbehaving. And trying to get a sense of forecasting these food prices, even in the very near term, is fraught with a huge amount of challenge. So that's on the one side. The other side is the growth angle, which has disappointed us with a very soft number. So I think broadly the message which is probably going to come out from the RBI is that yes, there was a miss, and that miss on growth is likely to pull down their forecast for GDP growth. So possibly they will probably bring down 7.2% GDP growth estimate for the current financial year to somewhere close to 6.7, 6.8%. This is what we would expect. Our own internal estimate is that GDP growth will be much lower at 6.4%. Now, even with that assumption, I think the deductive logic tells us that, let's say, if we are forecasting a 6.4% GDP growth for the full year, for second half, GDP growth probably will be much higher. So first half GDP on an average was 6%. And if somebody is forecasting a 6.4%, then essentially what it implies is that the second half GDP growth will be 6.8%. So incrementally, I think H2, the second half, is going to be better than H1, because agricultural output will come on board. So all the talk of a healthy kharif sowing, all that will now start seeing the light of the day. There is reason to be optimistic on the Rabi sowing bit. The reservoir levels are pretty healthy, and there is an expectation of winter rains which are likely to be favorable once again. So net agriculture probably will be the lone shining star. In fact, it could actually uplift GDP growth in the second half of the financial year. Second reason that we anticipate things to have bottomed out, at least as far as GDP growth is concerned, that uh, the government spending, which essentially was on a slow turf, post-election and post the government formation that happened, that was yet to show any perceptible signs of a pickup. Now, if the government actually would intend to be as close to the budgeted targets as possible, for that to happen, they'll have to step up the gas uh, pretty much in terms of spending, both revenue expenditure as well as capital expenditure. And when that happens, it is likely to impart a boost to your GDP growth as well. So second half GDP growth is likely to be higher. The bottom point is that, and that will give RBI some comfort, and probably it will try and portray the situation that things are not as bad as the Q2 GDP growth data portrays. Now, having said that, yes, the broader point of other central banks easing interest rates is true. And so far, RBI has avoided that temptation of joining other central banks. In fact, of late, this trend is now on a slight back foot, because 2 months back, when the Federal Reserve started easing interest rates, the easing started with a big bang, with a 50 basis points rate cut, and market participants were expecting 100 basis points rate cut before the end of 24. They were expecting almost 250 basis points rate cut before the end of
Right.
2025. Now, those expectations have now got scaled back, especially after the US presidential elections. Now, the entire market is just pricing in about 75 basis points additional rate easing from the Federal Reserve. That's a step back. So, 50 to 75 basis points of rate cut has now got priced out by market participants. That's the most recent development. So incrementally, essentially, from an RBI perspective, what this means is that the pressure, the peer pressure to cut interest rates will be lower now than what it was 2 months back.
Right, fair enough, Vivek. The thing is that, the big question is, can the RBI actually even tame food inflation? It doesn't have direct control over it. Is it then time to, boost growth by cutting rates? Some say, RBI is in a cycle behind when it comes to doing that as well.
That's a fair point, and food inflation doesn't come under the direct control of the RBI. But at the same time, food inflation has linkages with other components of inflation. So, food inflation, if it continues to remain elevated for a long period of time, it will start feeding into other components of inflation. So, you and I will probably go and ask for a raise because food inflation has been high and because your inflation expectations go for a reset. So, what essentially food inflation can do, or elevated level of food inflation can do, is that it can set off or trigger a wage price spiral in the economy. And once that gets triggered, it will take a lot of remedial action from the central bank to control it. So you don't want to get into that situation where that wage price spiral gets triggered, and you would want the inflation problem to be controlled at the earliest stage as possible. So that's one thing. So food inflation doesn't control directly or doesn't get impacted directly, but it does have a bearing on other components of inflation, including inflation expectations. Now, as far as growth is concerned and looking at inflation is concerned, I think what we are essentially doing is, given the nature of the shock that GDP data presented, we are focused on the Q2 GDP, and at the same time we are focused on the the inflation, which is currently above 6% being driven by food. For the year as a whole, if you look at the entire year as a whole, GDP growth in all probability would be close to 6.4, 6.5%. That's not a bad GDP growth outcome. I do agree that it is lower than what RBI was expecting or projecting, but even a 6.5% GDP growth for the entire fiscal year as a whole is not bad at all. And from an inflation perspective, also, the 6% inflation that we currently are seeing is expected to be temporary. So, probably by the end of March, you'll start seeing sub 5% inflation numbers pretty soon. So net, I think the broader picture is that growth has moderated. It has not been as high as one was anticipating it to be, but it's not a crisis situation. The crisis situation for India probably would occur when growth starts coming below 6% on a regular basis. So when you have a full year outlook where you're projecting sub 6% growth, that is where you have a problem. Currently 6.5%. If you ask any multilateral body like the IMF or the World Bank, they'll probably put 6.5% GDP growth as the trend line GDP growth for India. In fact, if you look at what IMF is projecting for India for the next 5 years, they are projecting an average of 6.6% GDP growth, which is pretty much close to where the long-term trend for India is. So it's not a bad outcome per se. Yes, it's a disappointing outcome vis-a-vis what was expected by the central bank. Again, if I have to point it out in its entirety, the chief economic advisor's own estimate for GDP growth was in the range of 6.5 to 7%. So it's still meeting that estimate. It's on the lower side of the estimate, but it's still meeting that estimate for the year as a whole.
All right, we will leave it at that. We're completely out of time here on that discussion. Vivek Kumar, economist at QuantEco, thank you so much for taking time out to be with us here on In Your Interest.